This is Sunday, February 2nd, 2026. 2 days after, silver crashed from $121 to $95. 2 days after the largest single-day wipeout in silver in over a decade. And I am about to show you something that will change how you see these markets forever. What happened on Friday was not an accident. It was not a natural market correction. It was not panic selling by retail investors. It was a calculated, coordinated, deliberate attack on the silver price. And I can prove it. By the time you finish this video, you will see the fingerprints, you will see the timing, you will see the motive, and you will understand exactly who did this, why they did it, and what they are trying to steal from you right now at this very moment. Because this was not a crash, this was a trap. A trap designed to separate you from your wealth before the biggest transfer of financial power in modern history. If you sold silver on Friday, you fell into the trap. If you are thinking about selling now, they are counting on you. And if you do not understand what I am about to show you, you will be their next victim. Welcome to AG Archivist. If you are new here, I uncover the real mechanics behind market moves while everyone else repeats the headlines. Subscribe right now because what I am about to expose is the kind of analysis that makes powerful people very uncomfortable. And if this video opens your eyes, smash that like button. The algorithm buries content like this. Your engagement is the only thing that fights back. Now let me show you exactly how they crashed silver and why they needed to do it right now. Let me start with the timing because it tells you everything. Silver crashed on Friday, January 31st, the last trading day of January, the last day of the week, the last day of the month. This was not a coincidence. This was precision. Let me explain why this date matters. January 2026 was the largest silver month in over 40 years. Silver rose 65% in 30 days. It went from $73 to $121. An unprecedented move, historic, record-breaking. Hedge funds were long. Retail investors were long. Momentum was building. The narrative was shifting. Silver was becoming impossible to ignore. And that was a problem for certain people, very powerful people. People who are short silver, people who owe silver they do not have. People who have made bets that silver will stay low forever. These people needed to change the narrative. They needed to stop the momentum. They needed to shake out weak hands before February began. And they had exactly one day to do it, Friday, January 31st. End of the month options expiration, end of month futures settlement, end of week trading, maximum pain opportunity, minimum trading volume, maximum leverage on price moves. They chose the day, they chose the hour, they chose the moment. This was not a market reaction. This was an operation. Now, let me show you the mechanics of how they did it, because understanding the method is crucial to understanding who did it. Silver did not crash because of selling. Silver crashed because of short selling. There is a massive difference. Selling means you own something and you sell it. Short selling means you sell something you do not own, betting you can buy it back at a lower price later. On Friday morning, a massive wave of short selling hit the COMEX silver futures market. Not at the open, not gradually throughout the day. It happened in a concentrated burst during a specific time window. Between 8:30 a.m. and 10:00 a.m. Eastern Time, over 75,000 futures contracts were sold short. That is 375 million ounces of silver. Let me put that number in perspective. Annual global silver mine production is 835 million ounces. In 90 minutes, someone sold the equivalent of 45% of the total annual global production. They did not mine the silver. They did not own the silver. They created it out of thin air on a computer screen. This was not investors getting nervous and selling their positions. This was institutional level ammunition fired at a specific target at a specific time for a specific purpose. This was war. Now let me show you who did it because the data points directly at them. The commitment of traders report tracks positions held by different categories of traders. The latest data shows something remarkable. Commercial traders, which include bullion banks, increased their net short position by over 12,000 contracts in the week leading up to the crash. That is 60 million additional ounces shorted right before the price collapsed. They knew it was coming. They positioned for it. They profited from it. Now, you might say, that is speculation. You cannot prove they coordinated the crash. Fair enough. Let me give you more evidence. Look at where the selling occurred. Nearly all of the crashes happened during US market hours. When Asia was trading on Thursday night, silver was stable. When Europe was trading on Friday morning, silver was stable. The moment New York opened, the crash began. Every single red candle, every major down move, every wave of selling occurred during COMEX trading hours. When New York closed, the selling stopped. This pattern repeated for the entire week leading up to the crash. Asian hours, stable or rising. European hours, stable or rising. US hours, aggressive selling, price collapse. This is not random. This is not global selling pressure. This is concentrated activity from a specific geographic location during specific time windows. The fingerprints are American. The fingerprints are institutional. The fingerprints are on the murder weapon. Now, let me tell you the motive, because without a motive, you do not have a crime. Why would banks crash silver? Why would they take such aggressive action at this specific moment? The answer is simple. They are trapped, and they needed to escape. Let me explain the trap. For years, banks have maintained massive short positions in silver. They have sold silver futures contracts that they do not own. This is how they have suppressed the price for decades. As long as the price stays low, they profit. They collect premiums on their short positions. They make money every month, and the price stays flat or declines. But when the price rises, they lose money. And in January, silver rose 65%. That is catastrophic for anyone short. Let me show you the math. If a bank is short 50 million ounces of silver, and silver rises $48 in 1 month from $73 to $121, that bank just lost $2.4 billion. $2.4 billion in 1 month, in one position. These are not small losses. These are extinction level losses. These are the kind of losses that destroy banks. And there are multiple banks in this situation, multiple massive institutions staring at billions of dollars in losses, losses that get worse every single dollar silver rises. They had two choices: accept the losses and face potential bankruptcy, or crash the price and escape the trap. They chose option 2. Now let me show you how the trap works on you, because this is the part that should make you angry. The banks had a problem. They were losing billions. They needed to exit their short positions. But here is the catch. To exit a short position, you need to buy. You shorted by selling. You exit by buying back. If banks started buying millions of ounces to cover their shorts, the price would explode higher. Their own buying would make their losses even worse. They needed someone else to sell to them. They needed retail investors to panic. They needed you to sell your silver so they could buy it and close their positions. That is why they crashed the price. Not because silver is worth $95. Not because fundamentals changed. Not because demand collapsed. They crashed the price to create fear. Fear that makes people sell. And when you sell in fear, who is buying? They are. The same banks that crashed the price are now covering their short positions with your metal. They short the market. The price drops. You panic and sell. They buy your metal at a lower price. They cover their shorts. They escape. You lose. They win. This is not a market correction. This is a wealth transfer mechanism, and you are the source of the wealth being transferred. Now let me show you the evidence they are covering, because it confirms the entire thesis. COMEX inventory data shows something remarkable happening right now. In the 2 days since the crash, 3.2 million ounces of silver have moved from the eligible category to the registered category. Let me explain why this matters. Eligible silver is metal stored in COMEX vaults but not available for delivery against futures contracts. Registered silver is a metal that can be delivered. When silver moves from eligible to registered, it means someone is preparing to deliver physical metal. Someone is settling their obligations. Someone is closing positions. 3.2 million ounces in 2 days. That is not normal. That is not random. That is panicked covering. The banks that crashed the price are now scrambling to find physical metal to close their positions. They are moving every ounce they can find into deliverable status. They are raiding every vault they can access. They are desperate. Now, let me show you why they are desperate. Because this is the part of the story that mainstream media will never tell you. The physical silver market is broken. There is not enough metal, and the banks know it. Here is the reality they are facing. COMEX registered silver stands at approximately 8.7 million ounces. Banks are short over 300 million ounces in futures contracts. Do the math. There is not enough registered silver in COMEX vaults to cover even 3% of the outstanding short positions. If even a small percentage of futures holders demand physical delivery, the system collapses. The banks cannot deliver what they owe. This is called a default. This is called a failure to deliver. This is called the end of the paper silver pricing mechanism. They know this is coming. They have known for months. The 65% rally in January accelerated the timeline. Every dollar higher brought more attention. More attention brought more delivery demands. More delivery demands exposed the shortage. They were running out of time. The crash was not about profit. The crash was about survival. They crashed the price to slow down the momentum, to shake out weak hands, to buy time, to find metal, to avoid default. This was an emergency measure, a desperate move by desperate institutions facing an impossible situation. And now you understand why. Now let me give you historical context, because this exact playbook has been used before. In March 2020, during the COVID crash, silver dropped from $18 to $12 in a matter of days, a 33% crash. At the same time, you could not buy physical silver anywhere. Premiums exploded to 50%, 70%, 100% over spot. Dealers were sold out. Mint stopped taking orders. The paper price was $12. The real-world price was $20 or higher. What happened next? Silver recovered to $8 within weeks. Then it ran to $30 by August 2020. A 150% move from the bottom. The crash was a trap. The people who sold at $12 lost. The people who bought the dip won. The same pattern happened in 2008. Silver crashed from $20 to $9 during the financial crisis. At the bottom, there was no physical silver available. Premiums were astronomical. The paper price was fake. What happened next? Silver ran from $9 to $49 by 2011, a 440% move. The crash was a trap. The people who sold at the bottom lost. The people who recognized the manipulation won. The same pattern is happening right now. They crashed the price. Physical silver is unavailable. Premiums are exploding. The paper price is fake. What do you think happens next? Now, let me show you what is happening in the physical market right now, because this exposes the lie completely. While the paper price says $95, here is what is happening in the real world. The US Mint has suspended sales of silver eagles. When products came back online, prices jumped 86% overnight. The Perth Mint in Australia has suspended wholesale orders for silver bullion coins until late February. They are implementing monthly allocations. Rationing language. The Royal Mint in the UK is out of stock on silver bars. Even basic 1 kilogram bars are unavailable. Indian dealers are defaulting on deliveries, taking payment and failing to deliver the product. Costco is implementing purchase limits on silver bullion. Shanghai silver is trading at $135 while COMEX says $95, a 40% premium. Dubai premiums are running 40% to 50% above spot price. Japanese premiums have hit 60% above spot. Stop for a second. Process what I just told you. Every major source of physical silver on the planet is either sold out, suspended sales, or charging massive premiums. And the paper price just crashed 22%. Does this make sense to you? Does this look like a market where silver is worth less? Or does this look like a market where the paper price is a complete fiction designed to manipulate your behavior? Now let me tell you the real plan, because this goes deeper than just escaping short positions. What I am about to tell you is the part that most people are not ready to hear, but you need to hear it. The crash was not just about banks covering shorts. The crash was about accumulation. Let me explain. The same institutions that crashed the price are now buying physical silver at the lower price. They are using the fear they created to accumulate real assets at a discount. This is not speculation. We can see it in the data. Vault transfers show physical metal moving into institutional hands. Mint purchases show large orders being filled while retail is locked out. Import data shows record silver flows to institutional buyers in Asia and the Middle East. They are not bearish on silver. They are extremely bullish on silver. They crashed the paper price so they could accumulate physical metal at the depressed price. When they are done accumulating and have acquired enough metal to profit from the next move, they will let the price rise, or they will no longer be able to stop it. Either way, the price goes higher, much higher, and they will own massive amounts of silver they acquired at $95 while you sold yours in panic. This is how wealth is transferred from the public to the elite. This is how the game has always been played. They create the crisis. They profit from the crisis. You pay for the crisis. Now let me show you the evidence of institutional accumulation, because the numbers do not lie. China imported 4,600 metric tons of silver in 2025. That is 148 million ounces, the highest annual import in recorded history. In January 2026 alone, China imported an additional 780 metric tons, that is 25 million ounces in 1 month, while crashing the paper price. India imported over 200 million ounces in December and January combined, record-breaking numbers. While the paper price crashed, the Shanghai Futures Exchange is draining 27 tons per day. Physical metal leaves the exchange and enters private storage, while the paper price crashed. Do you see the pattern? The paper price goes down. Physical accumulation accelerates. They say one thing and do the opposite. Their words say sell. Their actions say buy. Their screens say crash. Their vaults say accumulate. Follow the metal, not the headlines. The metal is moving east. The metal is leaving public exchanges. The metal is entering private hands. They know what is coming. Now, let me tell you what is coming, because this is why the accumulation is happening. Silver is critical to the modern economy in ways that most people do not understand. Solar panels require silver, every single one. Electric vehicles require silver, hundreds of components. 5G infrastructure requires silver, billions of connection points. AI data centers require silver, massive amounts for heat dissipation and electrical connections. Medical devices require silver. Antimicrobial properties make it irreplaceable. Water purification requires silver. Military applications require silver. Global industrial demand for silver hit 680 million ounces in 2025. That is 81% of the total mine supply consumed by industry alone, before a single coin is minted, before a single bar is poured, before a single investor buys an ounce. Industry is consuming almost all of the available mine supply, and demand is growing. Solar installations are exploding globally. EV adoption is accelerating. AI infrastructure is expanding exponentially. Industrial demand for silver is projected to exceed total mine supply by 2027. Let me say that again. By 2027, The industry alone will need more silver than the entire world mines. That is before investment demand, before monetary demand, before jewelry demand. There will not be enough silver to go around. This is not speculation. This is math. This is physics. This is inevitable. And the institutions crashing the price today know this. They are using the crash to accumulate before the shortage becomes undeniable. They are front-running the crisis they see coming. Now let me tell you how to protect yourself, because knowledge without action is useless. If you own physical silver, understand what you have. You own something that industrial civilization requires. You own something that China is hoarding. You own something that India cannot get enough of. You own something that mints cannot keep in stock. Do not let a manipulated paper price scare you into selling. The paper price is a lie. Your metal is real. The people crashing the price are accumulating the metal. Follow their actions, not their words. If you are thinking about selling, ask yourself this question: who is buying when you sell? The answer is the same institutions that crashed the price. You would be handing them exactly what they want at exactly the price they want. Do not be the victim. Be the one who understands. If you want to buy, keep in mind that physical premiums are high right now. That premium is not a ripoff. That premium is the real price. The spot price is the fake number. Pay the premium if you can find inventory. Inventory is more valuable than price right now. If you own paper silver, ETFs, futures, or mining stocks, understand the risk. If the physical market breaks down, if delivery failures cascade, your paper claim may become worthless. You own a promise from a system that cannot fulfill its promises. Consider carefully whether that is the exposure you want. There are 3 types of people watching this video right now. The first type fell into the trap. They saw the crash and panicked. They sold their silver on Friday. They locked in their losses. They handed their metal to the institutions that crashed the price. They do not even realize they were robbed. The second type is standing at the edge of the trap. They are scared. They are thinking about selling. They do not understand what happened, but the fear is real. They might sell tomorrow. They might sell next week. They are one headline away from becoming a victim. The third type sees the trap clearly. They understand the mechanics. They understand the motive. They understand who benefits. They are not selling, they are holding. Some of them are buying. They know that this crash is an opportunity, not a crisis. They will be on the right side of the wealth transfer. Which type are you? Let me leave you with this. On Friday, January 31st, 2026, silver crashed 22% in a single day. That same day, you could not buy physical silver anywhere in the world. The US Mint was closed, the Perth Mint was suspended, the Royal Mint was sold out, Indian dealers were defaulting, Costco was rationing, Shanghai was trading at $135 while New York was at $95. One of these is real, one of these is fake. The institutions that crashed the price are now accumulating physical metal at the discounted price. They are converting paper profits into real assets. They are preparing for what comes next. And they are counting on you to sell your silver to them in fear. That is the trap. That is the real plan. That is how they steal your wealth. They crash the price, you panic, you sell, they buy, you lose the metal, they gain the metal, then the price rises, they profit. You look back and realize you were robbed. This has happened before. It is happening again right now. The only question is whether you see it for what it is. I see it. Now you see it too. I will continue to track the situation and bring you updates as it develops. Subscribe if you have not already. Hit the notification bell so you do not miss what comes next. Leave a comment letting me know whether you held through the crash or are considering buying the dip. I read every single comment. Remember what I showed you today. They crashed silver on purpose. They did it to escape their short positions. They did it to accumulate at lower prices. They did it to steal your wealth. That is not a conspiracy. That is the data. That is the mechanics. That is the motive. That is the evidence. This was not a crash. This was a trap. And now you know how the trap works. This is AG Archivist. The real story is never what they tell you. I will see you in the next one.